Let's get to the final trade of the day with Mark Sebastian of OptionPit Mentoring. Before we get to that trade, we have to talk about the bond market and this talk about a potential recession. Everybody's worried here, Mark. As a trader, what's your take?
So I want to talk about the insanity of relating this yield curve inversion, right? So near-dated bonds are trading at a higher yield than longer-dated bonds.
Correct.
So the fear around that is absolutely insane, because what we're looking at and what we're dealing with right now is nothing like the other yield curve inversions we've had. We've had 10 major ones in kind of the modern era since they listed futures. So what makes this one so different, Angela?
Exactly.
What do you think?
Well, partly because we have some decent things going on in the economy, and I feel like this is a bit of a knee-jerk reaction, but at the same time, you never know. The bond market can be very smart.
It can, but I want to tell you what's so different.
Okay.
Every other yield curve inversion took place in a rising interest rate environment, not a falling interest rate environment.
And that's what's happening
All
here.
10 of them, and we're in a falling interest rate environment. So what we're seeing is actually the effects of central bank intervention. We've got Euro NERP, negative interest rates.
Right.
We've got the Fed lowering rates. You don't see this type of stuff happening. So the reason why our yield curve is inverting is that you have very large players that are trading off the fact that we have a positive yield versus Europe having a negative yield, and it's a carry trade, and that is it. So,
but money always finds a way.
Money finds a way to make money.
Right, and that's why this is happening.
Right. So the idea that this is a precursor to a recession. Right, the reason why the yield curve was always a precursor to a recession when we inverted was because interest rates were too high, right? And that was going to slow down the economy. Yeah, the 10-year is 1.5%. That's not going to slow down the economy. 10-year 2%, not going to slow down the economy. So this is not like any other yield curve inversion we've ever had. Now, could we still have a recession? Could I be wrong? Sure. But the idea that this is anything like history, right? If you don't understand history, you're doomed to repeat it.
Right.
But if you're married to history, you're living in the past.
Right.
All right. And so you have to understand that there are major differences between this yield curve inversion and any other one that we've ever seen. So that is why I'm kind of ignoring that in terms of my long-term market, my near-dated and intermediate-dated market outlook.
And fair to say, a lot of things are happening in this market that are surprising to traders and investors that, frankly, we've never seen before. So we're in this uncharted territory area. Let's talk about what a potential trade would be for you.
I mean, I think at this point, the kind of yield curve inversion trade is played out. The recession fears, I think, are overblown, and I think those are played out. We kind of know everything going on with China. Those tensions have eased. I think that over the next few weeks, heading into Labor Day, we're probably going to see the S&P make another run at 3,000.
Wow, okay.
And so I like very simple, like long index funds, long call options in the SPY or SPX. Just simple long the market, I think, makes a lot of sense here.
It was wonderful to have you here. Thanks so much for your Trader Talk today.
Thank you.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.